Good morning. Welcome to today's learning module, Taxation 101, Your Tax Basics Explained. My name is Diane Brown. I'm a Chartered Accountant and Business Advisor with SRJ Walker Wayland. My passion is education and educating business owners on the importance of planning for success and working with you to develop strategies to help you achieve your growth and profitability goals. Today, we'll be taking you through the basics of taxation. So we'll be looking at what is income tax, what is taxable income and the key components such as assessable income and allowable deductions. We'll look at how you calculate how much income tax you pay and the mechanisms through which you pay it. We'll talk about the requirements to lodge a tax return, and we'll also have a look at the basics of the operations of the goods and services tax. So firstly, what is tax? So tax is the contribution that we all make to the government revenue that's levied on individuals, businesses, properties and goods. There are two key ways we pay tax. There is a direct tax, which is paid by the person that earned the income, which is the tax that the majority of us as salary and wage earners are used to, and it's in the form of income tax. Another example of a direct tax is fringe benefits tax. Then we have indirect tax. Indirect taxes are those that are passed on to the end consumer, and possibly the best example of an indirect tax is the goods and services tax. We have many more indirect taxes here in Australia, unfortunately, such as stamp duty, fuel tax, excise and customs duty. In terms of taxation, we have three levels of government here, and all three levels of government implement different types of taxes. So at the federal government level, we will have our income taxes, our goods and services tax, our fringe benefits tax, customs duty, excise, etc. At the state level, the Queensland and other state governments levy payroll tax, stamp duty and land tax. And then we also have our local government, which is our council rates, etc. that we pay, which is another form of tax. So what is income tax? Income tax is the tax that is paid on your taxable income. And taxable income is classified as your assessable income less any allowable deductions you are entitled to. So we're going to break that down into each of the key components. So the first thing that we need to look at is assessable income. So assessable income consists of ordinary income plus any statutory income we receive during the year minus any exempt income that we may be receiving. So the first component in this is looking at our ordinary income, and there's 9 key characteristics that make up ordinary income. And the key things that the tax office looks at when determining if something is classified as ordinary income and therefore part of your assessable income are things like beneficial receipt. So that means you need to be in control of the income that you're receiving. You don't have to physically have received it. However, as long as it's dealt with on your behalf, it is classified as being beneficially received. And a good example of this is for those people who might have dividend reinvestment plans. So in those type of plans, you don't actually receive any cash from those dividends, rather you receive additional shares. Those shares that you receive, the value of those shares become part of your ordinary income under the beneficial characteristic rule. The second rule we look at is money or money's worth. However, there are some adjustments to this rule where things such as non-cash business benefits that are received and barter transactions are assumed to be money's worth and hence assessable. Another key characteristic of ordinary income is that it exhibits regularity. So it's something that comes to you on a reasonably regular basis. Having said that, with all good tax rules, there's always exceptions. So there are some lump sum amounts that you may be receiving that will also be assessable income. Normal proceeds of personal exertion, and personal exertion is things like your salary and wages, tips and bonuses that you might receive, and property sales and business income is classified as ordinary income. Another interesting point to note is even if the income is received from illegal gains or immoral ways, it may still be considered income from a tax office perspective. For those of you who may have been in receipt of compensation receipts, if that is a lump sum amount that is deemed to replace the loss of a potential income stream, that is still considered to be ordinary income. Then we have our statutory income, and possibly the best example I can give you of statutory income is capital gains. So I hear a lot of people talk about capital gains tax. Capital gains tax is not a tax in itself. Rather, you pay income tax on the capital gain that you earn that is included in your assessable income. And you are including that capital gain by virtue of some statutory provisions. Then we take off any exempt income that we may receive. So there are a number of different types of exempt income, such as Social Security, some pension payments, etc. And then there's exempt entities, such as some not-for-profits, charities, etc. So the key types of assessable income that you would look at including in your taxable income is income from personal exertion, which is our salary and wage type income and tips and bonuses and things. Then we'll have our income from property. And there are three key types. Things such as rent, dividends, and interest, what we classify as income from property. And then we will have income from businesses. So one other thing to bear in mind when you're calculating taxable income is you need to consider when the income has actually been earned. And we call this the derivation rule. So there are two different ways that you can earn or account for income. One is on a cash basis, which is when you actually physically receive the cash, and one is on an accruals basis, which is when you actually earn the cash. The interesting thing to remember about the timing rules is it doesn't matter what type of taxpayer you are. Rather, from an income tax perspective, we look at the type of income that you're actually earning. So income from personal exertion, your salary and wage income, etc., is taxed on a cash basis. So when you actually physically receive your pay. Business income is taxed on an accruals basis. So when you have earned the income, it is assessable regardless of whether you have received the cash or not. Revenue received in advance, or what we call unearned income, if you receive a upfront deposit, for example, before you complete a service, if that deposit is non-refundable, then it is assessed as on a cash basis. If it is a refundable deposit, then it is assessed on an accruals basis once the service is performed. Income for professional practices, such as accountants, solicitors, doctors, etc., depends on the size of the professional practice. So for a small professional practice, and there are a lot of tax rulings around what is classified as small and large, but generally speaking, a small practice might be a one, possibly a two-person firm. They are assessed on a cash basis, whereas all other larger professional practices are assessed on an accruals basis. And finally, any income from property in the form of rent, interest and dividends is assessed on a cash basis. So I get asked a lot by people in the startup stage where it starts to move from a hobby into a business and hence become part of your taxable income. I think the key thing to note is that there is a lot of tax law in this area that has derived 5 key, what we call badges of business, for you to consider if you are running a business or not. The most important one of these is the profit motive. So anybody that's doing an activity for the sake of making a profit, provided they do so in a systematic way, they are more likely to be deemed to be running a business. The other badges are things that we look at, such as the repetition of acts and transactions. So how often do you do what you do or sell what you are making? We look at the commercial nature of the activities. So things such as, do you have a bank account? Do you have a business plan? Do you issue invoices and give quotes? So all of these things would be indicative of you running a business. The size and scale on its own is not you can't look at that in isolation, because you can have 1 or 2 transactions, and if they're larger transactions, you still might be considered to be running a business. And in terms of the profit motive aspect, you can be running a business that generates losses, but just because you're generating losses at that particular time does not mean you do not have a long-term profit motive, and hence you are classified as running a business. So that's the first side of our taxable income equation, looking at the various components of what goes in our assessable income. The second side is looking at your allowable deductions. And there are 2 limbs that we look at here. The first limb is what we call our positive limb, which simply says that you're entitled to a tax deduction for any expense that is incurred in relation to producing your assessable income. However, it is apportioned to the extent that it relates to that income. The rule to remember here is incurred, and it's very different from a deduction side of things to a cash side of things, to our assessable income side of things. So from an assessable income side of things, we talked about the difference between cash and accruals. And we said that various types of income are assessed, some on a cash basis, some on an accruals basis. From a deduction perspective, we look at the meaning of incurred. And incurred doesn't necessarily mean that you have to have physically paid the cash. It simply means that you are definitely committed or legally obligated to pay that amount. So you can still claim a tax deduction for an expense you have incurred, regardless of whether you have physically paid the amount or not. Unless, and this is where we get to the second limb of our deduction eligibility, unless that amount is capital in nature, so it's in relation to purchasing an asset, although there are specific tax provisions now, such as the instant asset write-off, that will allow us to claim that, which is the fourth point there that says there is a provision of the Tax Act that either allows it or prevents it. Unless that expense is in relation to a private or domestic act, or if it relates to exempt income. The next thing we're going to look at is individual tax rates. So as an individual taxpayer, we operate under what we call a progressive tax system. So we have a marginal rate system, which means that the more you earn, the more tax you pay. There are some rules around this in terms of residency. So it's important that you understand whether you are classified as a resident or a non-resident for Australian taxation purposes. The majority of us here today will probably be classed as Australian tax residents, so I'm not going to touch on the non-resident implications. For an Australian tax resident, all you need to bear in mind is that you are taxed on all income from all sources, whether within or outside of Australia. So how much tax will you as an individual pay for the 2021 tax year? So it's a sliding scale, and I have the rates up here behind me. So how do we use this tax table to work out how much tax you pay? Well, firstly, the ATO has some great tax calculation tools to enable you to do this, but just to give you an example, if I earned $100,000, I would pay tax. I would fall within the $45,000 to $120,000 threshold. So that means on my first $45,000 worth of income, I pay $5,092. Then the balance of $55,000, which falls in the $45,000 to $120,000 tax bracket, I pay tax on that $55,000 at 32.5%. So on $100,000, my income tax payable is $22,967. Unfortunately, it doesn't stop there, because we also have Medicare levy, which is our contribution to our public hospital and health system here in Australia. So your Medicare levy is generally set at 2% unless you are classified as a low-income earner that qualifies for a Medicare levy reduction, and there are income thresholds that apply to be eligible for those reductions, or you have a Medicare levy exemption. So if we go back to our $100,000 example, we've calculated our tax payable is $22,967. Your Medicare levy is payable at 2% on the entire amount you earn. So there's no threshold attached to Medicare levy unless you qualify for one of the exemptions. So you pay 2% on the whole 100,000, which is another $2,000. So you end up paying a total tax and Medicare amount of $24,967. From that is your key income tax payable plus Medicare levy. You then take out any tax credits or tax offsets to work out what your final taxable income or tax refundable will be. So before I start talking about tax offsets, I'll take you through the Medicare levy surcharge. So in Australia, we have a strong public health system, and to support that system, we require people that are classified by the Australian Taxation Office to have earned income above a higher income threshold to pay a Medicare levy surcharge if they do not have appropriate private hospital cover. The rationale behind the Medicare levy surcharge is to encourage people to take up private health insurance to remove some of the pressure from our public health system for those that can afford it. So they classify as people that can afford it. If you are a single taxpayer, the base tier requires you to have Medicare levy, private health insurance and private hospital coverage, importantly, if you earn above $90,000. And there's various tiers that are in relation to that. As a family, your threshold is $180,000, although that threshold will increase by $1,500 for every child after your first child. So if you don't have private hospital insurance, and bear in mind, particularly with some of our younger demographic, private health insurance can consist of hospital coverage and your ancillary coverage, which is things like your physios, your optical, your dental, etc. For the purposes of the Medicare levy surcharge, you must have the private hospital coverage. You don't need to have the ancillary coverage, although you may still deem to need it. So depending on what tier your income falls within, if you do not have private hospital insurance, you'll be hit with another 1 to 1.5% Medicare levy surcharge. So what I say to clients is, in a lot of cases, it's actually cheaper for you to have private health insurance than it is for you to pay the Medicare levy surcharge. And you get the benefit of being protected with that private health coverage. So do your research before you get hit with a nasty surprise if you don't have private hospital cover. So we discussed how you would calculate income tax payable plus Medicare on your assessable income or your taxable income. The next thing that you do is you look at your tax offsets that you're eligible for. So your tax offsets are different to tax deductions. Your tax deductions reduce your taxable income. Your tax offsets reduce your income tax payable. They're two different concepts. So there are two types of tax offsets. The first type is a non-refundable tax offset. And some examples of these are the low income rebate, the private health rebate if you have private hospital insurance and you don't claim the rebate directly from your health fund. There's some zone tax offsets, there's some invalid and invalid carer rebates. There's a raft of different types of tax offsets that you might be eligible for. And then we have the refundable tax offsets. So these are the ones that result in you receiving a tax refund. So a refundable tax offset are things like tax file number withholding tax, franking credits, pay-as-you-go withholding tax, and any pay-as-you-go instalments tax that you have paid. So we've talked about the difference between a tax deduction and a tax offset. A deduction is good, it reduces your taxable income, but a tax offset is great because it reduces your tax payable. A non-refundable tax offset is good because it reduces the amount of income tax you pay, but a refundable tax offset is great because it's the one that gives you that tax refund. So we love tax offsets because they give you a dollar for dollar reduction in your tax payable. So that's how we calculate income tax payable for an individual. What about if you're a partnership or a trust? A partnership or a trust is not considered to be a separate legal entity. So if you are in a partnership, the income is distributed to the partners in accordance with the partnership agreement and taxed accordingly. So if you're in a partnership as two individuals, your share comes out, it's taxed as your individual marginal rates, the way we discussed before. If you're in a trust, there are different types of trusts. So we have discretionary, or what we commonly refer to as family trusts, and we have fixed unit trusts. These, in a trust situation, the income is distributed in accordance with the trust deed and is distributed to the beneficiaries nominated in that trust deed and taxed accordingly. So if you are an individual beneficiary of a trust, your trust distribution is included in your individual tax return and it is taxed at your marginal tax rate. Bear in mind with trusts that there are special rules relating to the distribution of income regarding present entitlement and legal disabilities. So trusts and partnerships themselves do not pay tax. Rather, the partners and the beneficiaries pay tax. From a company is a separate legal entity, so it is taxed in its own right. With a company, there is no tax-free threshold. So as an individual, our first $18,200 is tax-free. When you factor in the low income rebate, it ends up being around $21,500 that you can earn before you start paying income tax. From a company perspective, you pay income tax from the first dollar that you earn. So generally speaking, the company tax rate is currently 30%, unless you are classified as a base rate entity or a smaller company, in which case the 2021 tax rate is now down to 26%, down from 27.5% in 2020. And a base rate entity is generally, there are rules, one that is classified as having aggregated turnover of less than 50 million. So how do we pay tax? So as an individual, you will pay pay-as-you-go withholding, which is the tax that your employer withholds from your salary on your weekly or fortnightly basis. The other way that you pay tax is through pay-as-you-go instalments. So business taxpayers will pay pay-as-you-go instalments on business income, and any individuals with investment income exceeding certain thresholds will also start to be brought within the pay-as-you-go instalment regime. So individuals and companies can be paying pay-as-you-go instalment tax. How do you pay those? Both of those components are paid via an instalment activity statement if you are, for example, an individual who only has individual investment income, or as a business through your business activity statement. So I get asked a lot by people, I didn't earn $18,000 this year, do I still need to lodge a tax return? The answer is possibly, because there are a lot of rules. So anybody that earns over $18,200 must lodge a tax return. Anyone that earned less than $18,200, however had pay-as-you-go withholding or pay-as-you-go instalments, must also lodge a tax return. But there is a whole raft of other situations up there where you will still need to lodge a tax return even if your income may be below that individual tax-free threshold. So you need to be familiar with whether you fall within one of these requirements to still lodge if you are under that $18,200 threshold. As an individual, if you lodge your income tax return yourself, it must be submitted before the 30th of October each year, unless you use a tax agent, in which case you can take advantage of our extended lodgement program. If you are not required to lodge a tax return, I strongly recommend you still submit a non-lodgement advice form. For a trust and a partnership, again, because their income can be distributed to individuals, they have an income tax deadline to lodge their income tax return of 31st of October, unless they use a tax agent and take advantage of our extended lodgement deadlines. A company. A company has, if you're classified as a small company, your tax return must be lodged by the 28th of February unless you have outstanding prior returns or you use a tax agent. If you are classified as a large or medium company, your return must be lodged by the 15th of January, again unless you use a tax agent. So that's the nuts and bolts in a condensed version of income tax in Australia. The other key tax we pay in Australia is the goods and services tax. So what is it? We all pay it. It is a 10% broad-based income tax, indirect tax I should say, on consumption. The price that you pay for all goods and services is the GST inclusive price. And in Australia, unlike other countries such as the States, for example, our price that we display on our docket must be that GST inclusive price. Bear in mind that the GST, even though as an end consumer we pay it, GST is charged and collected by registered entities at each stage in the chain before it gets to the end consumer. And I'm going to show you how that works with an example in a moment. Where we are required to charge and pay GST, but we're also entitled to claim what we call our input tax credits, which is we can claim a credit for the GST we pay provided we are registered for GST. The registration thresholds in Australia are $75,000 for those who are operating a business or $150,000 for our not-for-profit organisations. And there are two ways that we account for GST. One is on a cash basis, which the majority of small businesses use, which you are entitled to claim your GST credits as and when you pay them, and you charge GST when you receive it. So it might be better for your cash flow to be on a GST cash basis if you are a small business. A small business is classified for the GST purposes as one that has less than 10 million aggregated turnover. Anybody over the 10 million threshold must account for GST on an accruals basis. How do you pay it? You remit your GST on your business activity statement. So again, different threshold here. If your GST turnover is classified as being less than 20 million, you will lodge your business activity statements and remit your GST on a quarterly basis. If your GST turnover is greater than 20 million, then you must remit on a monthly basis on your BAS. There are still some taxpayers who voluntarily register. For example, if you're starting a new business and you are running a business, but your turnover hasn't reached the $75,000 threshold, you may want to consider registering for GST so that you can claim your GST input tax credits on any expenses that you incur, particularly in the startup phase where you might be spending a lot of money purchasing assets, such as Tim has here at A1 with his film equipment and TVs, etc. So in that situation, if you're earning less than $75,000, you may still want to voluntarily register. In that situation, you will pay your GST on an annual business activity statement. So now let's look at how the GST actually works. And to show you how it works at each level of the consumption chain, I'm going to start at the manufacturer level. So in this example, I've assumed that we have a manufacturer that is manufacturing a digital camera. So they are manufacturing this camera and selling it for $100. So at this particular point, they would be claiming input tax credits on their raw materials that they would purchase to go into making the phone. So we're just going to start looking at from the time the phone is actually manufactured and ready to be started to be sold. So the manufacturer makes it, he wants to sell it for $100. So that means the manufacturer charges $10 GST. So the GST payable that would go on to the ATO for this particular transaction is $10. The manufacturer gives the ATO $10. Then we come to the wholesaler stage. The manufacturer sells to the wholesaler, who sells to the retailer, who sells to us as the end consumer. The wholesaler will purchase that camera from the manufacturer for $110, including GST. So he will have an input tax credit to claim of $10. He now wants to sell, or she, I should say, now wants to sell that camera for $200 plus GST. So that means they charge $20 GST on that transaction, but they can claim back the $10 input tax credit that they paid to the manufacturer. So at that particular point in the chain, another $10 is remitted to the ATO. So they get $10 from the manufacturer, they get $10 from the wholesaler. Then we go to the retailer. So the retailer, at this particular point in time, buys the digital camera from the wholesaler for $220. So they have a $20 input tax credit. This retailer decides they're going to sell that camera for $300 plus GST. So they sell the camera by charging the $30 GST. They claim an input tax credit for the GST component they paid to the wholesaler, which was $20. So at that particular stage, another $10 is received by the ATO. Finally, we come to the end user. The end user pays $330 to that retailer. So in total, there is $30 of GST that has been paid at all stages throughout the chain. And that's how GST is collected throughout our consumer cycle. So how do we calculate it? So GST is payable on what we call a taxable supply. So your taxable supply is calculated at the value you want to sell it for plus the 10% GST. So if I want to sell a TV for $1,000 plus GST, my sale price needs to be $1,100. And just a little bit of a tip, a practical tip, if you purchase something and you want to work out how much GST you've actually paid, the easiest way to do this is simply get your total price and divide it by 11. So if we have a look at the example behind me, we've got our TV, we paid $1,100 for it. How much GST did I pay in that transaction? Divide it by 11 and I'm back to my $100 amount. So that is my practical tip to help you work out how much GST you've paid. So we pay GST on a taxable supply. There are two other types of supplies. One is a non-taxable supply, and these are what we call GST-free supplies. So these apply to things such as basic food, health, education, exports for consumption outside of Australia. So basic food is anything that isn't changed from its natural state. So if you go to Coles and you purchase a pizza from the deli section, that is removed from its natural state and it would be subject to GST. So in a GST-free supplies, you don't charge GST, but you can claim credits for the income tax credits that you have paid. Input tax credits, I should say. The third type of GST supply we have is an input tax supply. So these are things such as financial services, which is loans, interest, dividends. You don't pay GST on those. Residential rent and the sale of residential premises is also not subject to GST unless it is the sale of a commercial property or you're renting a commercial property or the GST margin scheme applies. We're not going to talk about those rules today. So generally speaking, if it is an input tax supply, you don't charge GST, but you can't claim your input tax credit. So just a quick summary of the rules around when you can and can't claim GST and when you need to charge GST. If you are making a taxable supply, you charge GST, you claim your input tax credits back on your purchases. If you are making a GST-free supply, you don't charge GST, but you can claim your input tax credits. If you are making an input tax supplies, no GST is charged and there is no entitlement to an input tax credit. So we've covered quite a bit today in our 30-odd minute session. This is just a very basic overview on the key components of income tax and goods and services tax. If you'd like to know more about your personal income tax or goods and services tax situation, please don't hesitate to contact me, Diane Brown at SRJ Walker Wayland. Thank you for your time.